This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead. With insight on the people, companies, and trends shaping today's complex economy. Plus, global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Masser and Tim Stenivek. Live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon to all of you. I'm Alexis Christoforous, along with Isabel Lee, in for Carol Masser and Tim Stenivek. They're actually headed west. They're going to San Francisco, Isabel.
How fun.
That's because they're going to be coming to you live tomorrow for the San Francisco Bloomberg Technology Summit. But we're here, keeping things in order. And we want to set up this next hour because we've got a chock-filled next hour, Isabel.
A lot of action going to happen. We have the Fed Beige book, an interview with the CEO of Macy's later on in the show. And markets are just really interesting now. We're seeing a renewed advance in oil, pushing stocks lower and, of course, pushing bond yields higher, again, as an escalation of hostilities bring to question whether we will see peace between the U.S. and Iran. Equities snapped a 9-day winning run if you're looking at an S&P. So really, we're bucking a big winning trend here, Alexis.
We are, and I'm just going to go out there on a limb and call it New York Knicks Wednesday. Can I do that? Because the Knicks, they're gonna kick off this NBA Finals tonight in San Antonio. It's supposed to be the most watched finals game in over 2 decades. But who's counting, really?
Who is counting? I'm not a sports fan, but I am updated with some of the activities and festivities. Like there's one subway station, it was painted in Knicks colors. It was around social media.
As it should be. Also confirming, or at least in the New York Post, waiting for the White House to confirm, President Trump will attend the Knicks game June 8th. That's Monday at Madison Square Garden. It's going to be game 3 and, of course, the first game here at home. So we're super excited about all that. We're also super excited, might I say, about the Federal Reserve's Beige book. We're expecting that report to hit any moment. We've got Bloomberg Stuart Paul with us, and really such a treat because I usually spend my mornings with this gentleman and his bow tie. Tom Keene is joining us today as well. He's going to not only talk about the Beige book and all things finance, but also he's got a new show because we just like to keep Tom Keene busy. So he's got Bloomberg Money. It's going to premiere this Friday along with Scarlet Fu. So we're going to talk to him about all of that. But that Beige book, it looks like it's just hitting now, the May Beige book. And Stuart, I don't know if you had a chance to see any of the headlines or if you can talk about it. All right, Stuart, what's sort of the big takeaway at the moment from these headlines?
What matters most is what evolves between each Beige book. So the last Beige book that we had was in April. Today we have one for June. As of last April, economic activity was expanding in just 8 of the 12 Federal Reserve districts. Most lately, economic activity has been expanding in 10 out of the 12 Federal Reserve districts. So a little bit more growth dynamic taking place as we move further into the second quarter. On the inflation front, it was the case that prices were increasing at a moderate pace in April, now moderate to strong across all the districts. Labor market front, labor market is softening between Beige books. In the previous report, labor market activity, the pace of hiring, had increased in all but one of the Federal Reserve districts. Now there's little to no change in all but one district. And in that one district, activity is cooling.
What about signs of consumer financial strain? What are you seeing on that end? Because that's one of the things you were keeping a close eye on.
Well, so look, the consumer is stretched thin. Tax refunds have helped. We have seen nominal spending continuing basically apace, but real economic activity on the consumer spending front is a little bit more fragile right now. That's certainly the case.
Alexis, everyone talks about the K-shaped economy. And when I read one of the notes this morning by Vincent Delaware of StoneX, he actually talked about the splintering within the upper K. So, I mean, just because you're in the top end of the K, so to speak, doesn't mean that, you feel like you're loaded and like money is great.
They're headed over to Dollar General and Family Dollar,
yes.
Right? They're shopping at those places.
That's right.
Does this report tell us anything at all about gas prices? Because we know that so many Americans are now grappling with, such high gas prices.
A little bit, but beyond gas prices, consumers are just focusing on those necessities because they are stretched thin by things like elevated gasoline prices. So not only are there fewer discretionary trips to discretionary retailers, but there are notes that consumers are focusing on necessities, and there are also notes that consumers are depending more on credit cards so that they can afford those necessities.
Fed Bank of New York President John Williams said he sees no obvious path or direction for the path of future interest rates. I'm wondering if this Beige book gives him any more clarity on that path.
Well, when I look district to district and I think about the preferences of each regional bank president, the Beige book gives us an opportunity to think about what's going on specifically in Williams District in New York, where both retailers and businesses are noting that economic activity is still strong, and there's been a marginal improvement in manufacturing activity in New York. So to see a rotation from a relative dove like John Williams to a more balanced position, it's actually totally reflecting what's going on in his district.
I want to bring Tom Keene in here, bow tie and all, for his thoughts on this Beige book.
It's fascinating. What's so cool about this is how twisted Stuart Paul is. I mean, when you do George Mason economics, it's different than everybody else. The heritage of your academics is it's a free economy. Are we just getting a stimulus ride right now, or is it really innovation, Ned Phelps of Columbia's dynamism?
Definitely we're getting some support from stimulus. Tax refunds are carrying consumers through right now, and that's definitely the case in the face of higher gasoline prices. And look, let's face it, there's a reason why a lot of the voting FOMC presidents, the regional bank presidents, are incrementally hawkish. We're looking at people like Kashkari, Logan, and Hammock, all the markets-oriented folks.
They're all the George Mason types.
Well, they're the folks who see basically no signs of monetary policy restrictiveness in financial markets. And when that's the case, yes, there is stimulus that is supporting economic activity, and that's what's giving us this hot headline that activity is increasing in more of the districts around the country.
Isabel, what's so cool about this is the grind of the show that Alexis and I aren't in speaking terms, but within the grind of the show that we do every morning, I would say, Alexis, one of the underlying themes here is things are getting better. The employment's percolating, that innovation, that dynamism is out there somewhere. That's the constructive tone.
But I wonder if most people are feeling the dynamism, because I mean, we keep hearing about the large amounts of layoffs, especially within tech. But then we get the ADP report today, private companies adding 122,000 jobs. We'll get more clarity, of course, on Friday with the government jobs report. But there still seems to be that disconnect. Stuart, am I right? Where the average person is just going, really? Are things okay?
It's because a lot of the hiring is concentrated in just a select number of industries. So that's part of it. And when you look in the aggregate, there's relatively limited wage growth. If you look over the first 4 months of this year, so the annualized pace of nominal wage growth for the first 4 months of this year is just 3.5%. It's getting swamped by inflation. So even if you have hiring, which has been relatively hot, because it's relatively concentrated and because there isn't broad-based wage growth, you're getting exactly the dynamic that you're alluding to, Alexis, which is that folks are just feeling stretched thin, real economic activity is being pinched by higher prices, and a lack of real wage growth.
I guess so. And to Tom's point, we're so graced by his presence. I'm so honored, actually. I'm feeling a little nervous. But to your point, the economy is doing well.
You're feeling a little nervous?
Yes, in your presence.
This studio, Alexis, you're here because this studio is so damn nice. Plus the interns serve coffee.
What are we doing wrong in the morning?
Well, exactly.
That's what I want to know.
I'm sleepy in the morning. So economy is doing well, but consumer sentiment is near historic lows. I mean, the equity markets, as we all know, are breaking records.
Michigan's horrific, painful, truly painful.
How do you reconcile those two stories, Tom, in your years of experience, not to age anymore?
First of all, there's no analog back to this. I'm in the camp. You can't go 1999, 1870, whatever the analog is. What I would suggest is it's an original moment of technology. And I'm using that word like Technology Review at MIT 50 years ago. It's not about Brynjolfsson and all that and all the fancy modern Stanford stuff. It's about brute technology like the railroads. We didn't know across 3 spouts of the railroads where this was heading. I don't think we know where we are right now.
On that note, talk to us about how important and how timely your new show will be, which
we
is the
got so
Money
lucky
Show.
on this. I mean, they came to me I think 2-3 years ago, and they did a survey, and they said they really want to see Scarlet Fu, and they said, we don't know what to do with you, so come along with Scarlet. So we came up with a show, and it had 14 different names, including the Alexis Christophorus Hour, and finally it started gelling 6 months ago, and we just got lucky with the news flow. This is about taking my world and Mr. Bloomberg's world and funneling it with a vengeance into personal finance, retirement, and wealth management.
So
Nobody's really doing
things.
all those things, but doing it from a more academic and more industry standpoint with that same intensity. And to have Liz Ann Saunders on from Schwab, kicking it off as she did for years with Louis Rukeyser. And I went out to Gabriela Santos and I just begged at JP Morgan. She's got prodigious chops. And then we're just humbled by the people that are coming on right,
So
in
it's
the
going to
coming
be 12
weeks.
p.m. Eastern time. Is it 1 hour, 2 hour? How much later are we going to ask you to stay here, Tom?
No, that's okay. They've set me up. It's really good. The Four Seasons is 2 blocks away.
Oh my
And the
God.
Penthouse, they've got me. It's like, when Lester Holt was at NBC, they took care of him. It's the same thing here. And
Well, I'm glad
I
to
can
hear
get
it.
the surveillance pre-nap in before 12 noon on Friday.
But it's a weekly show, just to write weekly. We're not keeping
Every
it here
Friday.
later every day. Every
We
Friday,
talked a lot
12
about
noon
it,
Eastern.
and the answer was with Scarlett's success of all of her 12 noon platforms,
Right.
let's not screw that up. Like crypto, I don't do crypto after 12 noon, so don't ask me.
She's so versatile.
But
She
do they
does-
have crypto at George Mason? I don't think they,
They
do.
have a lot
They
of crypto
might
at George
have,
Mason.
yeah.
Crypto has picked up the mantle of free banking. George Mason.
Yeah,
is now the
exactly.
home
It's like
of
James
crypto.
Buchanan
Yeah.
101. The bottom line here is we didn't want to screw up the success of what Scarlett was doing with those kind of shows. So we slipped it in. I said Friday. That's the day I take off starting Labor Day. So
You take the helicopter,
You're going to
don't
miss
you?
me Monday. The helicopter really helps out.
Yeah.
The Sikorsky, I can't say enough how that's the game changer for us.
Well, Mr. Keene always elevates whatever show he's on here at Bloomberg. So really happy to hear about the show. Bloomberg Money, we are looking forward to it. Stuart, before we let you go, more on this Fed Beige book. Is there a region in the country that we need to worry about regarding this Beige book?
There's just one that stands out to me. And as I mentioned to Tom, I like to look in the Beige book for how things are evolving around the country so that I can have a little bit of a feel as to which way each regional Federal Reserve Bank president might be experiencing economic activity on the ground. And one of the voters on the FOMC who we don't hear very much from is Anna Paulson in Philadelphia. She's a voter now. And economic conditions in the Philadelphia region are relatively weak compared to much of what else I'm reading in the Beige book. And so it shouldn't come as a surprise that just a few weeks ago, she was incrementally more dovish than a lot of the folks that we've heard from more recently. For example, she did not want to change the easing bias that was included in the previous FOMC statement. Now the consensus seems to be moving towards removing that easing bias as Kevin Warsh takes the helm. But based on what we're seeing in local conditions in the Philadelphia Federal Reserve Bank region, I would not be surprised to see her continuing to advocate, for example, for that modest dovish bias.
Can I just say one thing?
Please
What
do.
you just heard
Please,
there,
10 things.
bronze it, quickly, bronze it. People here are like me without a real job. People like Mike McKee and Stuart grind it. That was I've never read the Beige book. I wouldn't know it. To me, it's a phone book of Staten Island. What he just said is what Bloomberg's all about, that minutia about some of these documents.
Well, I want to get your thoughts, though, Stuart, on something outside of the Beige book. Governor Chris Waller wanting to centralize sort of these back office operations at the regional banks and have it be in one large, Federal Reserve Bank. He's being met with a little bit of backlash here, saying, you know what, we're afraid that the power is going to be centralized in Washington. Waller's saying, hey, look, it's going to be better for taxpayers.
Sure. Look, Federal Reserve operations and scope creep are a constant point of debate. What's interesting about the Federal Reserve's distribution of systems is that it's based on a time when banking was really segregated around the country. Banking was really isolated by region. The Federal Reserve districts and the regional Federal Reserve banks did a very specific job in helping to facilitate transactions that were primarily local. Now that transactions do not need to be local and the share of transactions that are local has been shrinking through time, it does make some sense to follow exactly what Waller is suggesting by consolidating some of these processes in Washington. But there is a lot of inertia, especially to large bureaucratic organizations, and the Federal Reserve is certainly one of them.
Tom, can you share with us 0.01% of your infinite wisdom? If you were to choose one market that's getting the story right, do you think it's a bond market, the equity market,
Oh, that's
oil?
an awfully dangerous question right now. The answer is I don't think any grizzled pro knows the distortions are so great with this mass. I've been going back to momentum. I kid Lizanne about it, mass and velocity. It's so out of the ordinary that I fall back, and Isabel, you know this from the Pacific Rim, the litmus paper of the foreign exchange market.
Yeah.
And the answer is I got resilient dollar, and 2 hours ago we got a 160 print on yen. That confirms, down from that, folks, all the other tensions in the yield space coming up on 5% 30-year bond, the economic data, both hard and soft. You mentioned the Michigan number earlier. And in the stock market, the oddities of just how well we do. I've lost a mental grip of, for example, SOX or the Korean index. I can't understand it.
You know, I'm so glad you brought up the Japanese yen too, because it's forcing us to look at the currencies, Tom. Bloomberg Dollar Spot Index up about 4% here at 1205.63.
Wow. Yeah.
I haven't seen it that high, and I don't know. I think I'm going to say months.
Stuart, do you see a contagion here? I mean, forget about gaming, whether we're going to see intervention again by the Japanese. Forget about that. But the bottom line here is it is a sense of contagion, not now, but at some point.
I think that's part of it. I can't help but think that a lot of what's going on in markets is just strictly driven by flows and a desire to achieve some sort of flight to safety, in high tech and AI focused assets. And so when we're thinking about, say, macro fundamentals in Korea, it's completely disconnected from what we're seeing in South Korean equities. It's really just a global desire to gain additional exposure to a very specific industry. Now, who would think that in a period where global central banks are hiking to combat the potential broadening of inflation, that you would see increased rotation or increased interest in the growthiest industry around? But it does seem like that's exactly what's going on, because this is a structural technological shift, like you said, on par with railroads.
And quickly, Isabel, I would mention the little tea leaves out there. When you look at the politics of your Philippines right now, the complete upside down world of the Philippines.
So exciting.
To see peso go to 61.
Yeah.
Out to, I don't know if it's hit 62 yet, but these are some of the little tea leaves the pros look at away from what's the Dow Jones Industrial Average doing.
100%.
All right, we're going to leave it there. Tom Keene, not only is he co-hosting Bloomberg Surveillance, starting this Friday, he's going to be co-hosting Bloomberg Money along with Scarlett Fu every Friday, 12 p.m. Eastern. We're going to tune in for that. Stuart Paul, Economics U.S. and Canada economist here for Bloomberg, breaking down the Fed Beige book. Thank you, gentlemen, so much for being in studio with us. Want to get to a big interview now. We've got Bloomberg's Dani Berger with Bank of America CEO Brian Moynihan. They are live from the Forbes Iconoclast Summit, just a little southwest of where we are here in New York City. Dani.
Thank you very much. That's right. I am here with Brian Moynihan of Bank of America. Brian, thank you so much for sitting down with me.
Oh, it's great to be here, Dani. Good to see you again.
I just want to start, one of the things you've been very consistent on so far this year, whether it be conferences or in your earnings, just the strength of the consumer and the strength on your platform. Spending on credit and debt up 6% year over year, and yet gasoline prices are high. Consumer confidence is at rock bottom. If those types of things can't break the consumer, then what, if anything, can at this point?
So I think, just to give the stats, about $2 trillion goes from our consumers in the economy every year. About $5 trillion. Year to date's $2 trillion plus, growing at 5% in the aggregate, debit card a little faster. And it's going everywhere. Now, when you watch within that, you start to see your point about what consumers do. They're going to the gas station more times and spending a lower amount because they, from a budgetary basis, they don't want to spend that much. But they're still buying more in entertainment. It's up 13% year over year in the month of May. And so it's a little bit of a conundrum. And why is that true? Go back to your question, what would break them? Their unemployment 4.3%, job formation not as strong as theoretical numbers, but for the population growth, it's actually pretty strong at 60, 70,000 jobs a month. And so our team thinks we'll grow at 2.1% this year. And people say, well, you're optimistic. I'm saying, I'm telling you what the consumer's doing today. But what they say they're going to do will come true if job cuts really come through to lower levels of employment. Right now, a lot of these job cuts are open positions and attrition and things like that. They're not necessarily huge layoffs that are actually affecting because job numbers are going up.
Well, I know in your earnings you also noted, I think spending on gasoline was something up like 16%.
20-some percent.
Okay, it's 20-some percent. Is that something you're keeping an eye on?
Well, keep an eye on it. If you sort it by low, medium, and high income earning households, it obviously has about twice the impact of a lower third of income households than it does the medium or the higher. And so that's where you have to watch and make sure that they are able to carry that. And that's the people who go in the gas station more often still spending the $40. So they don't get as much gas for it, but they go more often and they ration how they spend it. They go to the places where gas is cheaper, let's just say that.
Right.
And you can see people micro-changing. They're going a little bit more to big box retailers, a little more secondhand stores, and all that adjustment is part of the K economy we talk about. But the reality is the incomes are growing for all those income segments. And so affordability is a real issue, but to fundamentally change affordability, we have to build more housing, so there's the supply pressure will bring the prices down. Affordability, gas prices at $4.50 or above. We've been there before, so it is affordable. It's just not pleasant.
Someone once made the comment to me, Meredith Whitney, as a matter of fact, basically said a lot of people are leaving the banking system that are especially on the lower income scale. They're turning to things like payday loans. She brought up the term shadow banking. I wonder if there is, or if you are concerned that maybe there is unseen stress in the system that has left the likes of a Bank of America.
When you look at the recent Fed data on consumer credit, the reality is that there are pockets of delinquencies that are a little higher for subprime credit. We as a company don't do that business, and our credit's as good as it's been in 50 years on the consumer side, and it's getting a little better. The flip of that, though, is we offer a set of products, a no overdraft account where you can't overdraft because you don't have checks, frankly, and what you do is all automated payments. We have a $5 a month account. We have a $500 loan where you pay no interest, no fees. You just have to pay it back. You can borrow it a couple times a year. So we're always working on affordability of our products. And our overdraft fees are $10 versus the market of $35 for those that choose to have overdrafts. So we have an affordability package in banking that's second to none. And if you look at our consumers, from the spending side, they look like everyone else. From the borrowing side, we tend to be more of a prime lender. Right. So you'll see some pockets. But even those pockets, if you look at some of our peer companies that are in those businesses, the delinquencies are fine right now. Everybody's worried about what happens next, but it all comes down to unemployment and people being employed and earning money.
Well, the other side of the economy that's going absolutely gangbusters is everything in AI. And it's really impacting capital markets, and Bank of America is very involved in a lot of these deals, whether it be blockbuster IPOs, Alphabet looking at raising equity, upping their amount from 80 to 85 billion. I wonder what impact you think that happens on the market, just because of the sheer amount of capital and things that are being issued. Is this something that the market can absorb and can absorb smoothly?
Well, it's absorbed it smoothly so far. And the debate will be whether at some point the revenue and the earnings multiples and the cash flow multiples all have to come in sync. And right now you're in that phase where there's a mass amount of capacity building anticipated of demand. And so when you look at it, one of the ways that we think about is we are a buyer of these services, and a big buyer. $13 billion in technology a year, it was $250 million this year in 26 on AI-related spending. And so the question is, what's the affordability of that? That will be the interesting question, how all this comes together. But right now, it's a heck of a stimulus in the economy, that going on. But the other part of the economy that we see is the small and medium-sized businesses. And it's interesting. As you think about them over the last year we had Liberation Day, and that was confusing for people. And then we had the tax law finally got done, that settled confusion. Then had trade, then you had immigration policy, that confused people. The deregulation, they looked for that. As you watched in the fall, they were pretty sanguine. They said, look, I can see how this all plays out. And then a lot of it got put back on the table. And so I think what you see in the small, medium-sized businesses, there's a lot of uncorked potential there. They can borrow on the lines of credit. They're borrowing a little bit more. The loan growth solid. They're mid-double digits and things like that, which is good loan growth. But they have so much capacity if they just had a little more certainty, and that's why they really want the war to end, so their input prices will come back down, because we see the gas pump. What really happens longer term is the products made with petroleum products come.
So kind of like through. At the gates, ready to go once
they're ready to go, and they just want certainty. Because if you're a big company like ours with 200,000 people, you have lots of people who pay attention to all this and tell you what's going on. Our research team, the best in the world. If you're if you and I owned a business and we were doing something, you have to do all that work yourself. And the easier it is to do that work, the more time you can spend on creating the revenue. So I think there's a little bit of a pop left out there beyond the AI, which is an unbelievable amount of spending and et cetera. There's another pop when general business gets more confident about the future path.
I'd love to talk about your business a little bit as it relates to AI. I think there was a lot of excitement that you came out with this announcement that your intern and your college hiring class look incredibly robust. At the same time, I know you were speaking at Bernstein saying something like 14,000 employees internally would also be basically reorganized, relooked at thanks to AI, not let go. Well, what are the mechanics of that? What does it look like to sort of remake, not let folks go, but remake a firm that's equipped with AI?
So if you think, this has been going on for years. So when you think about your employee base, you have a group of employees a day. You have the attrition that goes on because people take jobs, they retire, et cetera. So you have that. That's in our firms about 8%. So if you think about that, flip that, 8% times the 200,000 people means we have to hire more than 1,000 people every month to stay even in headcount. So that gives you a choice: am I going to hire replacements or not? The second thing you have then is the 14,000 people in 25 we took from one job in a company and put in another job through skills training. That's our own internal skills training. We hear about that in the public side, but we actually do it inside the company. And even in the technology, we have people who did product X and coding system X. They have now moved to code system Y and using these new techniques. So that all is about repositioning people. And so in the end of the day, we are moving mass amounts of people around.
Right.
And the key was we need young people. So we have 2,000 smart, brilliant kids coming in to be summer interns next week. And then 4 weeks later, we have 2,000 permanent hires, round numbers, coming in to be permanent hires. We've agreed to hire 8,000 kids from a community college in addition out of the next 5 years. We agreed to hire 10,000 veterans in the next 5 years. So we're always hiring people into this company, trying to create opportunity for people from a community college to come to our company, finish their degree, and have a better
Brian, can I just ask very quickly, because I'm about out of time. This stuff is also really expensive. Have you started to think about just the inference cost of all this AI stuff? Are you asking people to pull back and keep track of it?
We're not at that stage yet because, frankly, at our scale, the number's not that big. We have $70 billion expenses. I can see where people run into this, but we have all 200,000 people have it to use. We want them to learn from it. That's just general usage, but the very specific applications like in the coding area and stuff, that's costly, but it's paying for itself. And we're pretty confident in the business trade. We wouldn't do it unless we saw the business outcome we want, i.e. that the revenue or growth will exceed the cost we put in. And so, but that will be a gating factor till people can really, really identify that. You have to say, wait, if I get all these costs and it doesn't come true, what happens? So we're measurably putting in 100 projects. We got another 1,000 we're looking at and all this stuff. But we're always gating those. Are they going to produce the revenue, or are they going to produce the cost savings that we're supposed to have?
Ryan, thank you so much for joining. And by the way, I'm also looking forward to more World Cup announcements. I know you're giving away some tickets to veterans.
Yes, we just announced today we gave $2 million to buy $2 million worth of tickets to get a thing called VetTix for veterans and first responders, and that will. I'm sure everybody's looking for them right now. That comes live fairly soon. VetTix is a group that does other kinds of tickets that is owned by veterans, and they do it. So it's very exciting.
Brian, thank you again. Really appreciate your time. That, of course, Brian Moynihan, the CEO of Bank of America.
Thank you so much, Dani. What a fantastic conversation. That was Bloomberg's Dani Burger with Bank of America CEO Brian Moynihan, live from Forbes Iconoclast Summit 2026 here in New York City. They discussed a lot of things, Alexis. They talked about how affordability is a real issue. They talked about gas, which is what everyone talks about. I feel like I just forget about it because I'm a commuter and I use the subway. They talked about how credit has been good as it has been in 50 years. Moynihan says that the market has absorbed AI spending smoothly so far. They talked about hiring plans and how Bank of America is always looking to hire people from college students to veterans. So it was really a robust conversation.
Yeah, and it was also nice to see that their internship program, which is going to be kicking off their summer internship program, is very robust, and they're bringing on some entry-level folks.
Interns, yeah, that's a lot. I've been seeing them around the city. So again, great conversation with Brian Moynihan and our very own Dani Burger. Now let's get a quick market reset. I feel like we've been talking for a while now, and for that, we go to the one and only Charlie Keller.
All right, I thank you very much, Isabel Lee. And right now we got Bank of America shares. They are unchanged on the day. The Dow, the S&P, NASDAQ, all declining. Oil higher, stocks lower. That 30-year right around 5%. Right to the numbers. S&P at 75.75, down 34 now, down 0.5%. Dow Industrials down 403, down 0.8. We've got NASDAQ down just about 0.7%. On a down day for most stocks, though, the SOX, the Philadelphia Stock Exchange's Semiconductor Index, up by 1.9%. 10-year 4.48%. The 2-year 4.07%, and the 30-year 4.99%. Gold down 1.1%, $44.40 the ounce, while West Texas Intermediate crude up 2.4%, $96.05 the barrel. Brent $97.82, up by 1.9%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thanks very much, Charlie. We have the markets seeing some red arrows here, Isabel. We've got the three major indexes all chalking up some losses. S&P 500 has been on quite a run, 9 straight days of gains. Looks like it's going to hit a brick wall there today. And the Dow, at least in terms of percentages, down the most today, 0.8%, or about 412 points. Oil, though, back on the rise. We've got crude oil now up 2.5%, $96 a barrel. And we've got Brent crude nearing in now on $98 a barrel.
I think it's really a tech-led drop, and I'm looking at this key ETF tracking software firms. It dropped by more than 4%, and also a gauge of small caps declined by more than 2%. It's really been an interesting market. Like we asked Tom Keene earlier, Alexis, like which market is making the most sense? Is it the bond market, the equity market, the oil market? It seems like they're just not moving in synchrony, or at least in the historic way that markets or investors have expected them to move.
And I think we're all trying to navigate that. Also, just at the top of the hour, we started our program with the Fed's Beige book, latest report there from economic activity at certain regions of the country, 12 different regions, increased at a slight to moderate pace across most of the U.S. The big takeaways, though, most Fed districts did report higher inflation. I don't think we're surprised by that than in the previous reports, and driven again primarily by the war in Iran and this rise in oil prices, which we're all feeling really in so many different levels, but especially at the gas pump right now.
Definitely at the gas pump. We also had data today that showed companies added the most jobs since January 2025. So this signals that the labor market may be gaining momentum despite higher energy costs. So again, it's almost back to energy. And if confirmed in official government figures, the trend could support a shift that maybe the Fed is more likely to raise rates at the end of the month.
Yeah, June 16th, 17th, that next Fed meeting, of course, headed this one, the first one by our new Fed chair, Kevin Warsh. Have to get used to saying that.
Yes.
You just sort of want to just say Fed Chief Powell. You know, we've said it for so long.
Yes, and it's like when we have a new year. I always still write the old year, but yes, we just have to get used to it. We will get used to it.
We've got a lot to look forward to coming up. We're actually waiting on an interview with the energy president and CEO of Xcel Energy, Bob Frenzel. He's live in Las Vegas. He's going to be speaking with our own Tyler Kendall. And then later on, if you're able to stick around, folks, around 4:30 Eastern Time, Macy's CEO is going to be joining Bloomberg TV's Romaine Bostick to talk about their latest earnings report. So lots to look forward to there. But first, let's head out west, shall we, Isabel, to Las Vegas at the Fontainebleau, where we have got Bloomberg TV's Tyler Kendall standing by with Bob Frenzel. He is chairman, president, and CEO of Xcel Energy.
Thanks so much, guys. As you mentioned, I'm pleased to say I am here with the CEO of Xcel Energy, Bob Frenzel. Thanks so much for joining us here on Bloomberg Television and Radio. And I want to get ourselves situated because you serve customers across 8 states, from Texas to North Dakota. And we were talking a lot today about how a lot of these states are seeing a huge surge in electricity demand tied to the AI build-out. How prepared are our grids to handle this giant influx when it comes to this?
Yeah, well, thanks for having me. What a terrific question, and something we talk about every single day at Xcel Energy. You're right, we have a large footprint across 8 states, and data centers are driving electricity demand both this decade, and we even see more growth into next decade with our large data center customers. Big piece of our growth, you mentioned Texas and New Mexico. We serve also oil and gas customers in the Permian and Delaware basins, some of the largest, most prolific oil and gas customers in the country, and we're building infrastructure for them too, transmission, generation, distribution. So artificial intelligence is an incredible asset for the country, and data centers are critical infrastructure, but they're not the only things that are causing electric growth across our territories.
I want to talk about, though, one of these deals, because you signed a relatively massive deal with Google for a project in Minnesota. And I was pretty struck by this stat. Electric bills for Xcel Energy customers over the past 5 years were 29% below the national average. But as more hyperscalers get on the grid, can you keep that success rate up?
We're proud of our affordability progress with our customers. We do serve 6 of the lowest 10 cost utilities in the country. So I'm really proud of that fact. Actually, data centers and data center development help keep bills affordable for our customers. If you think about the Pine Island transaction we did with Google, this is about a 750 megawatt data center where Google's going to pay for all of their infrastructure costs. They're going to pay for the full rate of their transmission usage, not a discount rate or an economic development rate as we used to call them, but the full rate. And they're going to build all the new generation. We're going to build it, own it, and operate it on behalf of them, but they're going to pay for all the new generation that's going to serve their customers. And because of where we serve, we have an interesting and unique footprint at Xcel Energy. We can do it with wind, solar, large-scale batteries, and they're going to pay for all that, protect our existing customers. And in fact, because they're paying full transmission rates, we're going to see that over a 10 to 15 year period, we're actually going to save our customers $1 to $1.5 billion over a 15-year period. That translates to 1 to 2% lower transmission costs for all of our residential customers. That's a way to help lower bills over time as opposed to raise them due to data center infrastructure.
I wanted to pull out some more specific stats because Xcel has raised its 5-year capital plan by 33% to $60 billion. At what point does that rate of spending, though, become a concern for existing ratepayers? Is that going to get passed through? It's
a great question. Look, we're building a more modern, more resilient, more sustainable grid of the future, and that comes with investment. So it is sustainable. Over the last decade, we've been able to keep our bills well below the rate of inflation for our customers. And we expect over the next decade, we can keep it at or just above inflation and make sure that our customers have a more modern, more resilient, more sustainable grid for their everyday usage, as well as energizing new industries like the oil and gas industry in the Permian Basin, like data centers across all 8 of our states.
I believe you're committed to closing coal plants by 2030, right? But given that we were talking about the need for more energy, is that timeline still realistic?
So yesterday we filed our 21st sustainability report. I'm proud to say that Xcel Energy has lowered our carbon footprint since 2005 by 58%, and we're on a trajectory to be carbon-free by the middle of the century. Sustainable, yes. We've actually planned these commitments for over a decade, and we've built the infrastructure, or in the process of building the infrastructure, to make sure that we can meet the commitment to serve our customers reliably and affordably in the absence of coal, but we'll come back with wind, solar, storage, and natural gas as backup generation to make sure that we have a resilient and reliable grid for our customers.
I wanted to ask you about natural gas because we're seeing geopolitical tensions, what's happening in the Middle East, renew this conversation about energy security. Has that changed how you're thinking about natural gas, particularly as you're trying to make this bridge away from coal power?
You know, what's interesting about our conflict with the Russian conflict with Ukraine or the Iranian conflict with the United States is we've seen very little price movement in natural gas during the duration of those events. That means that we have an enormous natural gas resource here in the United States that when we need to, we can tap into it harder and faster. So we've been able to have energy security and resiliency here in the United States despite having global geopolitical conflicts. And we've had price stability, at least on the natural gas side. And so that makes me confident that when we need the gas, we'll have access to it. And when we have access to it, it'll remain reasonably affordable for our customers.
Let's also talk about the broader alternative energy space, renewable energy. I'm wondering what you've made of the Trump administration's approach when it comes to sometimes delaying or canceling permits related to these projects. Has that changed anything in the way that you're doing business? We've been building wind farms. We serve states that basically straddle the Great Plains, from Minnesota and the Dakotas to Colorado and Texas and New Mexico. One of the greatest wind resources, not just in the country, but in the world, to build wind farms. So we've been a leader in wind energy for 25 years. I think that's going to go unabated for us because we can, with the same amount of capital, deliver a lower cost energy product to our customers using wind. So our projects that are under construction remain under construction. Our projects that are in development are still in development. We're working through the permitting challenges, and we feel like we're going to be successful with wind now, wind into the future. And increasingly, we're doing a lot of solar, particularly in our southwestern business. You can imagine, Texas, New Mexico, southern parts of Colorado are incredible solar resources. And then lastly, I'd say, batteries have been an incredible asset for both the country and for Xcel Energy. We're going to build the largest long-duration energy storage project as part of this Google deal you mentioned in Minnesota with Form Energy. I'm really excited about commercializing new technologies to make sure that we can remain on a sustainability journey that we've been on for half a century. In the final minute that I have you, I did want to ask you about something that's come up here today, which is this potential NextEra Dominion merger. I'm just wondering your thoughts on it, if that's making you think about your positioning any differently.
Well, look, we've had an enormous partnership with NextEra over 25 years. They've been a partner in helping us build and own and operate wind and solar resources. We've actually announced a joint development agreement with NextEra to continue to build wind and solar and battery resources to serve data centers across our 8 states. They called us as they were engaging in this transaction. They've committed to our joint development agreement not changing in its structure or stature. And so I'm excited for them and their journey, but it's not going to affect our journey in our partnerships with NextEra.
All right, we have to leave it there. Bob Frenzel, the chairman, CEO, and president of Xcel Energy, thank you so much for joining us here on Bloomberg Television and Radio. Alexis and Isabel, I'll send it back to you guys in New York.
Thank you so much, Tyler. What a fantastic interview with the president and CEO of Xcel Energy, Bob Frenzel. Let's now get another markets reset with the one and only Charlie Pellet. Charlie?
Hi, thank you very much. Here's what's going on. The Dow, the S&P, NASDAQ, we're all in the red right now. Energy moving higher, specifically crude. Got to begin with WTI, a 96 handle right now. West Texas Intermediate crude, 96.30 a barrel, up by 2.7%. Barrel of Brent above 98.11 right now, up by 2.2%. So oil higher, stocks lower. S&P right now down 36, 75.73, down 0.5%. Dow Industrials down 418, drop there of 0.8%. With the Nasdaq Composite Index down 200 points now. Nasdaq down 0.7%. Cannot ignore the move in the SOX today. The Philadelphia Stock Exchange's Semiconductor Index, the SOX up by 1.3%. By the way, coming up after the close of trading, Broadcom up now by 1.2%. All of this with the VIX right around 16, a 10-year at 4.48%, the 2-year 4.08%, and the 30-year 4.99%. Gold at $44.38 the ounce, down 1.2%. Again, WTI 96.34 a barrel, up now by just about 2.8%. Oil majors are gaining along with the price of oil. ExxonMobil up 2.3%. Chevron shares, they're up 1.1%. ConocoPhillips up by 1.5%. Also, economic data today, just about 40 minutes ago, we got the Fed's Beige book. It shows economic activity increased at a slight to moderate pace across most of the U.S. in recent weeks. Unemployment showed little to no change. Isabel and Alexis, that is a Bloomberg Business Flash.
All right, thanks a lot, Charlie. And I'm so glad that Charlie brought up oil because I want to dig a little deeper now. So we do have oil prices higher today, but I was taking a look at our WEI screen, which shows us some year-to-date numbers. And year-to-date, West Texas Intermediate crude up nearly 68%. We've got Brent crude up about 61%. And I'm wondering, why isn't it even higher, given the fact that the Strait of Hormuz is now effectively closed for 4 months? So who better to bring into this show to talk about it than Will Kubzansky, Bloomberg News refined products reporter. Thanks so much for joining us here, Will, in the Bloomberg Interactive Brokers studio. What's going on with oil? Let's just break it down to today. What is the catalyst for the move higher?
Yeah, so today there is this broader sense that a deal to reopen the Strait of Hormuz, which, as you said, has been closed for 3 months, we're now in month 4, that deal is further away than previously thought. There were skirmishes sort of between the U.S. and Iran throughout the Middle East last night. There's this broader sense that, well, if we don't actually have a deal coming in the next couple of days, weeks, then reopening is going to take a little longer. The longer the strait is closed, the longer the world is cut off from about.
I don't know about you guys. I would imagine we would have Brent at over $100 a barrel right now.
Exactly. So that's the other question. Why isn't it higher than what it is today? I mean, oversupply from last year is hanging over. Investors aren't positioning for a longer conflict. Demand has fallen meaningfully. Why aren't we seeing above $100 per barrel, to Alexa's point?
This is the big question, and everyone's been trying to answer it. The really simple answer is we came into this crisis oversupplied. We had more oil than we needed, and we've been leaning on that buffer. There's also the fact that there has been some demand destruction in China. Interestingly, folks have turned to electric vehicles. Folks are taking high-speed rail where they might have once taken planes. There is a lot of stuff happening that's sort of decreasing demand, as well as just this buffer of supply. But there are a lot of warnings out there. A lot of folks are saying we are closer to a critical point than we might think we are. Prices should perhaps be higher, and they're going to get there. So it's just a question of seeing how it plays out.
Well, I'm glad you brought up EVs. Now it seems like used EVs are sort of all the rage, right? As people sort of at least go to the used market to save at least on gasoline, which we know is the highest it's been in months, with the national average well above $4 a gallon. And out in California, I mean, they are paying well over $6 a gallon to fill up. Talk to us about the latest EIA report, though. Talking about coming into this situation sort of well supplied, what does the latest report from the Energy Information Association tell us?
Yes. So last week, big draw on crude stocks, I think about 8 million, not including the SPR. We saw products build. So the U.S. stockpiles of gasoline built for the first time in 15 weeks. That was some much needed relief. Part of that is, right, Memorial Day, you buy a little more than you need if you're like a gas station, and then you sort of hold on to it for the next couple of weeks. So you're not pulling from the tanks. Diesel stockpiles built unexpectedly. That's important because folks have been sort of beginning to ring that alarm bell. We might be getting low on diesel. Not quite there yet, but absolutely still a concern.
How much of the recent move in crude do you think is driven by geopolitics versus underlying supply and demand fundamentals?
Again, something that folks have been trying to figure out for a while through this whole thing. Look, I think right now folks are saying that the market is trading headlines. There is just not a ton of positioning in the market either way. The trading has thinned since certainly before the crisis, and at the peak of sort of those price spikes, a lot of the moves that we see in oil on the crude futures at least are coming from geopolitical headlines. But there is going to be a game to play with supply and demand at some point.
I have to ask about summer travel and the airlines.
Oh, good one.
This EIA report showed jet fuel demand is holding up pretty well since the start of the war, even though I'm seeing a lot of those prices skyrocket, right? A lot of those airfares. What can we expect as we head further into summer?
The U.S. is producing a lot of jet fuel right now. The refiners have gotten the incentive to make more jet fuel. They're meeting that incentive. They are making more than 2 million barrels a day of the fuel. For context, that's been happening for 7 weeks prior to this conflict. That had never happened for more than 1 week consecutively. So just the scale of production is incredible right now. So yeah, flying, I think, and there's a great Javier Blas column on this, flying is maybe less at risk. What you get to those, there's this question of when you produce more jet fuel, inherently you're going to make less of other fuels. You're going to make less diesel. You're going to make less gasoline. There's a push and pull.
So we're going to pay for it somewhere, is what you're telling us, Will.
Somewhere in the balance, yeah.
Is gas at $4.20 a gallon, which I think, is that where it is nationwide now, about $4.20 a gallon? Is that has that historically driven demand destruction?
$4.20 a gallon is a point at which a lot of people are unhappy about the cost of gas, but demand for gas,
not too unhappy.
Not unhappy enough to cut back meaningfully. That level's probably, we've only gotten there once, it was in 2022, but probably $5 a gallon. But folks are certainly going to make noise about it, but they're also going to fill up their cars.
Well, in a midterm election year, I would imagine that is top of mind. So gas prices do become really a political football once again.
Yeah, 100%. It's, we're seeing the GOP now having to defend what the Democrats defended in 2022. Prices are really high. There has been a repeated claim from the White House that they will fall as soon as the conflict ends.
What is the next catalyst investors are looking at, or your team is looking at? Is it Iran inventories or something else?
I think the thing on the front of everyone's mind is Iran, right? We're all waiting for the next sort of headline on, is there a deal? How much longer is the strait going to be closed? With that said, right, there's concern about what's called tank bottoms, the point at which oil storage is no longer operationally viable. If we hit that somewhere, maybe it's in Cushing, Oklahoma, which is sort of the hub of U.S. oil, maybe it's elsewhere. I think folks might start to get concerned, but we haven't seen it yet. So yeah, look, all of the above, and something will inevitably come.
All right, let's say there is a deal. We can reach some sort of a peace deal that reopens the Strait of Hormuz. Do we flip a switch and things go back to normal? How long does it take for these oil prices to start to come back down to earth?
There is a range of estimates on this question. The things that need to happen, you need to get ships out of the strait, which there's still plenty of them stuck in there. You need to demine the strait to the extent that it's been mined. You need to start oil production again. You need to get refineries back up and running. There's been some capacity that's been taken out since the early days of the war. So a lot to consider. Not an immediate process for sure, but not clear how long.
Where do things stand with the strait at the moment? Is the U.S. still trying to usher ships through? Are ships going it alone? What's happening?
That is unclear at this point in time. I think, you are seeing certainly the flare up in military tensions the way we did when the U.S. was attempting to escort ships out in May. But yeah, there isn't a clear answer as to sort of what the state of play is in there right now.
In your takeaways of the EIA report, it's actually very helpful. And then you have a whole paragraph there on the stockpiles. It declined for the sixth straight week with inventories around 22.4 million barrels. Talk to us about the significance of that.
Yeah, declining crude stockpiles are a function of the fact that the U.S. is now sort of the world's petroleum supplier of last resort, right? We have oil that we can send out from the Gulf Coast and to a lesser extent from the East and West Coast. So our stocks have been falling. The fact that they're still falling means that the economics suggest it's a better deal to, send oil out to Asia or out to Europe. But as they continue to decline, there will be more and more discussion of what does this mean for us? Do we have enough to run? Certainly the answer is yes right now, but it's a question.
I really like the point that he made that the 420 is painful, but not painful enough in the Philippines, where I'm from. I forget the oil prices there or the gas prices, but it's so high now that some government offices have mandated work from home.
Really?
Some people just can't afford it. Yeah.
Yeah, it goes to show
It's
sometimes
really
we're in a
global.
microcosm here in the U.S., right? We need to branch out and realize, lots of folks are struggling with this right now. So should we all just settle in for higher gas prices for longer, do you think, Will?
Certainly higher than when the conflict began. Those prices were very low, and the EIA in their forecasts has stated we're going to have higher gas prices for longer, certainly than the $2.90 something we were paying in late February, early March. How much higher for how much longer is the question, and that will be determined by how quickly the strait reopens, and also how quickly you can reroute crude and products out of the Middle East, how quickly you can get creative with other solutions. So yeah, that's the duration question.
All right, we're going to leave it there. So much to dig into. I'm so glad you stopped by to talk about oil, because it's another day where oil prices are back on the rise. Will Kubzansky, Bloomberg News refined products reporter. Really appreciate your insights here.
Thanks for having me.
All right, we still have lots more to come here on Bloomberg Businessweek Daily. I'm Alexis Christoforous, along with Isabel Lee. You might be wondering, where are Carol Massar and Tim Stenovic? Don't worry, they're out west in San Francisco getting ready for our San Francisco Technology Summit, which is happening today and tomorrow, and they'll be doing the show live from there tomorrow. But coming up in just a bit here on Bloomberg Businessweek, we're going to take a look at some stocks on the move today, so be sure to stick around.
You're listening to Bloomberg Businessweek Daily with Carol Massar and Tim Stenovic on Bloomberg Radio and Television.
Welcome back, everybody. So glad you could join us on this Wednesday. I'm calling it New York Knicks Wednesday as this NBA Finals kicks off in San Antonio. It's been a long time in the making, so we are very excited about that. On a day when we have got some down arrows for equities, at least Dow Jones Industrial Average off more than 450 right now. We've got NASDAQ down about 200 as that AI trade takes a little bit of a breather. After the closing bell, we're going to get a big earnings report from Broadcom, really the last big chip company to come out with earnings. And of course, they're going to be all over AI. And S&P 500, want to squeeze that in there, down about 39 points right now. And of course, oil, which we just had a very robust discussion on oil, is higher for the day.
The S&P 500 snapping a 9-day winning streak. Yep. Really spectacular to witness. So we've been zooming out for a while. Let's now zoom in. Let's take a look at some of the stocks on the move today. Again, I'm Isabel Lee with Alexis Christoforous sitting in for Carol Massar and Tim Stenovic. And we are joined by Bloomberg News equities reporter Avalon Purnell. So thank you for joining us here in the studio, Avalon. What are you looking at? I think Ulta.
Yes, Ulta Beauty, that's ticker Ulta, currently down about 5.3% most intraday since March. And that's after the beauty retailer's outlook implied a slightly weaker than expected second half of the year. Jeffrey's writing that the conservative setup could leave room for upside as management remains cautious, especially as the war in Iran continues.
You know, Alexis, I don't know if I should admit this, but I've never been to an Ulta.
Wow.
I don't know why. I just always gravitate towards Sephora. I don't know.
Well, you know, Sephora's right across from us here at Bloomberg Headquarters in Midtown. But there are quite a few Ultas around.
A lot, yes.
And both stores have a different vibe, I must say. But I have to say, though, Avalon, Ulta's report, I mean, all the fundamentals that you want to see were there. So I'm a little surprised the stock is selling off the way that it is today.
Yes, you're absolutely right. It is also important to point out that May tends to be a down month. And so that's just what happens in the industry, whether you're Sephora, whether you're Ulta. And so some analysts did also point out to that people are expecting it to be slightly lower, at least for this month.
All right. You know what it is these companies have such high bars that they must now, jump over, that it's getting harder and harder to sort of beat on the high end of the estimates. All right, let's move on to GameStop, a winner today and a huge buyback.
Yes, that's ticker GME, talking about something that is slightly memey, currently rising about nearly 7% now, most intraday in a month. And that's after the video game retailer reported its highest profit ever, selling more collectible items, and also mentioning that the Pokemon cards, those action figures, are actually playing a slightly bigger role than the video games now, since people are kind of going more towards online to buy those things. And also, as you mentioned, the board did okay a $2 billion buyback.
Wow. Talk about confidence in your own stock, I guess. Yeah. But are GameStop stores still around? There used to be one not too far from me. They closed up. So are they moving more towards digital?
They still have a couple of stores.
Okay.
I actually, one of my coworkers, he just bought like a Pokemon thing.
Really?
Yeah.
I feel like GameStop just never leaves the headlines. Like it just
whether it's
always
a meme
is
stock,
there
I guess
every quarter.
Has it gone
or
through its
something.
meme stage? Because remember when this was, sort of almost the poster child for meme stocks.
Meme is what you said. I love that.
Yeah, I mean, it also tried to buy eBay. So
yes,
I feel like it still has to be kind of in the meme sphere when you're trying to buy such a big company.
I know. I mean, they're climbing really a lot higher today, so I'm grateful you talked about that stock. What about Medtronic? I think that's a medical devices maker.
Yes, that's ticker MDT, currently gaining about 5.5%, one of the top gainers on the S&P 500 today, and up most intraday since last November. That's after the medical devices maker reported revenue for the fourth quarter that surpassed expectations. There's a lot of really great notes out, Needham writing that those new products that they had this past quarter really drove Medtronic's strongest organic growth in a decade.
All right. Well, I just want to get back to GameStop for a minute, because I'm just looking this up right now, do they sell those Magic the Gathering cards? I mean, that's a huge...
I don't know.
Magic the Gathering cards, that's a huge thing too, and I have to think that that's also adding to this Pokemon, which seems to be a resurgence for Pokemon.
Yes. I would say anything retro at this point, very much something that people are going for.
I grew up playing with Pokemons, either watching it or having the cards. My favorite was Jigglypuff because she's pink and that is my favorite color. And I memorized all the 150 plus characters. So I thought that was behind me. But then my brother...
You memorized all 150 characters?
I think so. But then my brother now loves Pokemon again. And he's going to our attic and getting the old cards. And he said that they're valuable right now.
They are valuable, aren't they?
They are.
They're going for a lot of money, I guess, on eBay. And you have to wonder, when GameStop's CEO talked about wanting to buy eBay, a much larger company than GameStop in terms of market cap, sort of came out of nowhere. But did it do what he intended, which is get GameStop back into the zeitgeist?
I mean, Twitter would say yes, or formerly known as Twitter, X would say yes.
All right. Oh my God, this is so interesting. Thank you so much, Avalon Purnell, Bloomberg News equities reporter, for our stocks on the move. Always fun when we talk about those individual stocks, Alexis.
Love it. And you can catch all of our stock mover reports on our Bloomberg Stock Movers podcast. It happens several times a day, so you don't want to miss that.